finding product market fit. In video 1, we saw how a startup begins with a problem, builds an MVP, and gets its first customers. But getting your first customer is only the beginning. The next big challenge is finding something called product market fit. So, what does that actually mean? Product market fit means that you have created a product that people genuinely need and want to use. Imagine you launch an app and 10,000 people download it. That sounds impressive, but if most of them stop using it after a few days, something is wrong. Now imagine you have only 1,000 users, but they use the product regularly, recommend it to others, and are willing to pay for it. That is much stronger signal. Startup looks at customer feedback, retention, engagement, revenue, and referrals to understand whether their product is solving a real problem. They continuously ask, why are customers using our product and why are some customers leaving? The answers help founders improve the product. Sometimes the feedback can even force a startup to change its original idea. This is called a pivot. A startup may discover a different customers group, a better use case, or a completely new business opportunity. The important thing is that founders don't simply assume their idea is correct. They allow the market to guide them. Once a startup finds stronger product market fit, the focus changes. The question is no longer just does this product work? Now the question becomes how can we get the product in front of thousands or millions of people? And to answer the question, startup needs a strategy for growth. Understanding startup funding. Once a startup has a product that customers want, it needs resources to grow. This is where startup funding becomes important. But where does the money actually come from? In the early stages, founders may use their own savings. This is often called bootstrapping. They may also receive money from friends, families, or early supporters. As the startup grows, founders may approach angel investors or venture capital firms. These investors provide money in exchange for a percentage of ownership in the company. Let's take a simple example. Imagine a startup is valued at 10 crore and an investor invests 2 crore. In exchange, the investor may receive a percentage of the company. The exact amount depends on the agreement and the valuation. As the startup grows, it can raise larger funding rounds. You may have your terms like seed round, Series A, B, and C. These represent different stages of startup funding. Early funding may help a company build its product and finding customers. Later, funding can help it hire hundreds of employees, expand into new cities or countries, increase marketing, and improve its technology. But here's something important, raising money doesn't automatically mean a startup is successful. Investors are taking a risk. They want to know whether the company can grow significantly in the future. They look at the market size, revenue, customer growth, business model, competition, and the founding team. The startup also needs to use the money carefully. If a company receives a large investment but cannot build a sustainable business, it can still fail. So, funding is not the destination, funding is a fuel for growth. And once a startup has enough resources, it can focus on the next major challenge, that is scaling. Scaling from thousands to millions. Now imagine a startup has found product market fit and has raised enough funding to grow. The next challenge is scaling. Scaling means taking a business that works on a small level and expanding it to serve a much longer market. Imagine a startup that initially serves 1,000 customers. The founders now want to reach 1 lakh customers across multiple cities. They can't simply do everything manually. They need technology, systems, employees, marketing, customer support, and strong business processes. This is where scalability becomes important. A scalable startup can increase its customers and revenue without increasing its cost at the same rate. Technology companies often have a major advantage here. A software product can potentially serve thousands or millions of users without needing a physical store for every customer. But scaling also brings a new problems. Competitions become stronger. Customer expectation increase. The company needs to hire the right people and maintain product quality. It also needs to make sure that rapid growth doesn't destroy its finances. So, like such as customers acquisition, cost, revenue, profit margins, retention, and growth rate. They want to know not just whether they are growing, but whether they are growing in a healthy and sustainable way. Successful startups may expand into new cities, countries, products, or customer segments. As the company becomes larger, its valuation can also increase. Investors may value the company based on its growth potential, revenue, market size, and future opportunities. And this brings us closer to the most exciting stages of journey. When a private startup reaches a valuation of $1 billion or more, it earns a special name, a unicorn. But how company actually that $1 billion valuation? That exactly what we will explore in the upcoming video of video 3.